Hi guys, it's Stock Curry, and after the stock market opened deep in the red, it turned around and rallied. There was two key pieces of information that came out today that caused this. I'm going to tell you what changed and what it means for your stocks. So let's get into it. Overnight, Credit Suisse shares soared over 18% on an announcement that the Swiss National Bank would loan them money. Credit Suisse is now set to borrow up to nearly $54 billion from the Swiss National Bank. You might recall how yesterday the stock market fell on fears that Credit Suisse might be the next bank collapse. And if that were to happen, it would be the largest bank collapse in history. Now, Credit Suisse has been bailed out, which sent the shares skyrocketing. It should have sent the U.S. stock market shares skyrocketing as well. But the U.S. stock market actually opened the day deep in the red. That was because just as Credit Suisse was getting bailed out, First Republic Bank stock sank after a possible sale report. So even though Credit Suisse received a bailout, First Republic was now in fears of going bankrupt and being the next bank collapse. We just get over one fear and we got turned around and hit with another fear. Then as the day progressed, bank shares rebounded off of their lows as big banks came to the rescue of First Republic. Stocks immediately started rallying as soon as a rumor was released that a group of banks were in talks to deposit $30 billion into First Republic. About an hour before close, that news was confirmed, with Wall Street riding to the rescue as 11 banks pledged First Republic $30 billion in deposits. Bank of America, Wells Fargo, Citigroup, and JP Morgan Chase will each contribute $5 billion, while Goldman Sachs and Morgan Stanley will deposit $2.5 billion, and Truist, PNC, U.S. Bancorp, State Street, and Bank of New York Mellon will each deposit $1 billion. The deposits will be obligated to stay at First Republic for at least 120 days. First Republic stock, which closed at $115 per share on March 8th, traded below $20 at the open on Thursday. The bank had said on Sunday that it had more than $70 billion in available liquidity, not counting additional funds it could possibly raise from the Federal Reserve's Bank Term Funding Program. Now, earlier in the day, it was announced that First Republic was trying to sell the bank to a larger bank. However, the unrealized losses on First Republic's bond portfolio due to last year's rapid rise in interest rates have made an acquisition unappealing. The markdown, which would involve the bank's held-to-maturity bond portfolio, would amount to about $25 billion in the red on First Republic's balance sheet. So the $30 billion in deposits that these 11 banks have committed to First Republic will shore up its balance sheet and get it out of the hole, going from $25 billion in the red to $5 billion in the green, essentially saving First Republic Bank. So by the end of the day, both Credit Suisse and First Republic had received bailouts, saving them from collapse. This caused fear of more bank collapses to diminish significantly, with CNN's Fear and Greed Index rising from extreme fear at a level of 19 yesterday, all the way up to the fear level at a number of 29 today. Unfortunately, just as it looked like FRC stock was in the clear, First Republic Bank sank after suspending their dividend. Even though First Republic shares rose massively throughout the day from $20 all the way up to $34 in an insane 70% rise on the day, it did give back some of those gains with an after-hours drop of 13% after they suspended their dividend. That was the after-hours drop as of the recording of this video. And as First Republic mentioned that they had access to the Fed's crisis lending program, while they did not take advantage of it and instead received deposits from 11 other banks, many other banks did take advantage of the Fed's crisis lending programs. Utilizing the tools the Fed rolled out on Sunday, banks looking for cash infusions borrowed $11.9 billion from the Bank Term Funding Program, also known as BTFP. Under that facility, banks can take one-year loans under favorable terms in exchange for high-quality collateral. Most banks, however, took the more traditional route, using the Fed's discount window to borrow a massive $148.2 billion under terms slightly less favorable. The discount window provides loans of up to 90 days. The Fed on Sunday eased conditions at the discount window to make it more attractive for borrowers in need of operating funds. And there was also a large uptick in bridge loans, also done over short terms, totaling $142.8 billion. Those were made primarily to now shuttered institutions so that they can meet obligations regarding depositors and other expenses. You might recall how Silicon Valley Bank and Signature Bank, after they went out of business, there were a lot of concerns about the fact that FDIC insurance only covers the first $250,000 in deposits. And the Fed came in essentially providing unlimited FDIC insurance. And as a result of that, the banks actually went under, have now taken out bridge loans in order to cover the difference between the FDIC insurance and the amount that they actually owed to their depositors. That amount totaled $142 billion that the now shuttered banks were short. In total, the programs ramped up the Fed's balance sheet, escalating the total by some $297 billion. While the Fed had been touting quantitative tightening for the past couple of months in order to get inflation down, that took a huge U-turn this week, with the Fed's balance sheet ballooning by more than $300 billion. When the Fed's balance sheet goes up, this is known as quantitative easing, and this has the effect of pumping money into the monetary supply. That also, in turn, has the effect of increasing inflation, although the increase in inflation probably won't show up for another year or two. It does cause some big problems down the road, even though it fixes some very short-term problems. And yields on mortgage rates fell in the last week. Freddie Mac cites worries over bank closures and turmoil in the financial markets. Obviously, as the Fed dumped $300 billion into mortgage-backed securities, all that buying has the effect of dropping yields. Essentially, in an attempt to bail out the banks, the Federal Reserve has reversed all of their fight against inflation. They have decided that they will essentially allow inflation to run rampant so long as it means the banks don't collapse. This has the effect of causing yields on mortgages and treasuries to drop significantly, and that does help out the banks. But like I said, within the next year or two, inflation will come back. Now, in trying to decide what the Federal Reserve will do next week, it can help to take a look at what the European Central Bank did. The ECB defied mounting banking strains with a half-point rate rise. So why did the ECB look past the Credit Suisse drama to deliver a supersized rate hike? While the European Central Bank was more focused on inflation, the European Central Bank warned that inflation is projected to remain too high for too long. However, the ECB said future decisions would depend upon both economic and financial data. The ECB said it is monitoring current market tensions closely and stands ready to respond as necessary to preserve price stability and financial stability in the euro area. Just 1 week ago, central banks around the world were only focused on getting inflation down while keeping the labor market strong. However, that has all changed as the central banks around the world are now focused on fighting inflation while at the same time trying to protect the financial system. Unfortunately, these two things are at odds with one another. In order to protect the financial system, you have to lower rates. That causes inflation to go up. And in order to get inflation down, you have to raise rates, and that causes problem in the banking sector. That means that now, 1 year after the first rate hike, the Federal Reserve stands at a policy crossroads. In the past year, inflation has come down some, but it still leaves the Fed well short of its 2% goal. And with inflation still well above the Fed's goal, it raises questions about what's ahead and what the ramifications will be as policymakers continue to grapple with a persistently high cost of living, as well as a shocking bank crisis. Now, yesterday, CME futures were pricing in a 45% chance that the Fed would do a 25 basis point rate hike and a 55% chance that the Fed would pause. However, Fed funds futures traders pulled back on their 2023 rate cut expectations after Credit Suisse and First Republic banks were rescued. The futures are now pricing in an 80% chance that the Fed will do a 25 basis point rate hike at their next meeting and only a 20% chance that the Fed will pause. The Fed's next meeting is next week on Tuesday and Wednesday. On Wednesday at around 2 p.m. Eastern Time, we should get an announcement on how much the Fed will raise interest rates by and whether or not they're going to pause. At that same time, the SEP, or Summary of Economic Projections, will be released. And in there, we will get an idea as to how much the Fed plans to raise interest rates by throughout the end of the year, as well as whether or not the Fed plans to cut rates by the end of the year. And then about 30 minutes after that, around 2:30 p.m., Jerome Powell will speak and answer questions from the press. Now, it's important to remember that while the economy remains strong for now, we do have a recession on the horizon. Retailers see a tough year ahead, and they're already rolling out their recession playbook in order to get ready for an upcoming recession. Essentially, retailers are cutting back on buying some goods that aren't necessary, and they're spending more money on buying things like groceries that would drive consumers into the stores, things that people would buy whether we were in a recession or not, things like food and medicine. And in another sign that a recession is right around the corner, more than 5 million households are behind on their rent. As of February, renters in the U.S. owed nearly $11 billion in rent debt. So what does all of this mean for your stocks? Well, in the short term, a lot of uncertainty, but in the long term, as fears of the banking crisis start to settle down and go away, stocks should start rising again. Remember that April is historically the best month of the year for the stock market. Now, getting into May is historically the worst month of the year for the stock market. There's an old saying, sell in May and go away. And with the debt limit crisis upon us in June, it could cause a sell-off in May as we get closer and closer to the deadline where the United States government will no longer be able to pay their bills. So I do expect stocks to rally from here through the end of April and then sell off in May. We'll see what actually ends up happening. By the way, if you want to know everything that we're buying and selling and trading, and if more importantly, you want to learn how to trade options so that you can make money no matter whether the market goes up, down, or even trade sideways, then I encourage you to come join us in our We Profit Day and Night coaching program. We're running a sale right now for all current and former VIP members. If you want to take advantage of that and get back into the program, just give my onboarding specialist a call and he can get you all set up. The website to schedule that call is weprofitdayandnight.com. That's weprofitdayandnight.com. Now, tomorrow, I will be buying more stocks in the Millionaire Club portfolio. If you want to know what I'm going to be buying, then come check out the video that will be posted either Friday or Saturday. And then Sunday, we'll be back to another market update video to get you guys ready to go for the week ahead. If you get a lot out of this video, then be a good friend and share this video with your friends and family and on your social media pages so that they will know what's going on in the markets as well. And don't forget to hit the like button and subscribe. And if you missed yesterday's video, make sure you go watch it here because it has a lot more information about what's going on.